and welcome to a special edition of Earnings with ET Now, with the Nifty now at all-time highs and FII flows at a 5-year high, decelerating economic growth momentum. All eyes now on how earnings will turn out. Remember, in 2019, it's turned out to be quite a tumultuous year for the market. The polarized nature of the mid as well as those 12, 15-odd large caps, that continues. The earnings performance continues to elude us, and they have been tepid for the last 2 years now. So will the wait finally be over? Are we likely to see some recovery coming in, or are we staring at yet another tepid quarter? Over the next 30 minutes, we're going to be previewing the third quarter numbers for India Inc. Joining us today on the show, Gautam Duggar, Naveen Kulkarni, Pramod Gubbi, as well as Amnish Agarwal. But before I take it across to our experts, we've got Varun Hiremat from our research team joining in with a preview of how the financials, FMCG and auto sectors are likely to perform in this quarter. Varun?
Right, Aisha. So beginning with the financials, the banking sector pretty much stays true to what we've been hearing. The private banks will continue to outperform the PSU banks. Over there, SBI is best poised to do well due to the IBC recoveries as well as the ESAR case. On the private side, ICICI, Axis continue to maintain their positive momentum, with Yes and RBL in trouble. Now switching over to NBFCs, Bajaj Finance, Canfin Homes, HFCs and NBFCs with low funding cost and no problem with liquidity will continue to do well as others perish away. This actually becomes an opportunity for the larger players. Asset quality will also be a key monitorable for this quarter, as will lower credit growth. Now switching gears to auto, we are expecting another weak quarter from them. Lower volumes, lower margins, OEMs continue to suffer. The point of pain is highest for HCVs, people like Ashok Leyland in the heavy commercial vehicle sector, whereas passenger vehicles see some reprieve with guys like Maruti coming in with almost positive cues for volume, say they're holding up fine. Nonetheless, auto will continue to pain this quarter. And finally, on the FMCG, volume growth is looking pretty muted. We're looking at around 5 to 6% volume growth for them. However, due to the corporate tax rate cut, they will see some enhanced profits, and rural queues will also see some improvement due to a strong monsoon and better sowing in Rabi and Kharif. So H2 should be slightly better, but nonetheless, given the economic slowdown, FMCG will be slow as well. So on a holistic basis, financials seem to be holding up the indices, and FMCG and auto will continue to drag a fair bit.
Okay. Varun, thanks much for highlighting what really is the ET Now expectation of these tech sectors and what they're likely to do in the quarterly earnings. But Gautam, if I could start the discussion with you really on financials, and in particular, the most sought after, over-owned segment when it comes to banks, that's the corporate banks. Do you think that given the weak macro environment, corporate banks will still be able to outperform the rest of the basket? Or would you say that, you'd continue to watch out for the asset quality? There could be a few odd aberrations there.
Hi, Aisha. I think the corporate bank outperformance, which started in 2019, can very well continue for next couple of years. Because remember, we are coming out of a bad asset quality cycle of last 6-7 years. And CY19 was the first year where things were stabilizing. CY20 will be the first year where we will see the real profits in their P&L and some balance sheet improvement. So, when things have been bad, the banks continue to underperform for a very large period of time. And when things are now turning around, I think these banks can continue to do well for the next foreseeable future. Also remember that 65% of the banking system, which is PSU banks, SBI and maybe Bob, is still down in the dumps. Some of them are besotted with their mergers, some of them are finding capital related issues, some of them are still in PCA. So the incremental market share, whether it is loan or deposit, is all going to the large private banks, be it on the retail side or be it on the corporate bank side. At the margin, you have seen 4 big resolutions happening on IBC in this quarter. So the credit cost write back will happen for ICICI Bank, will happen for SBI. So the numbers that you may see this quarter from ICICI and SBI can really surprise, because this is the quantum of numbers that we have not seen for last 3 or 4 years. And secondly, also remember that banking is the only game in the town in FY20 as far as earnings are concerned. If you look at the Nifty earnings for FY20, ex of banking, there is a decline of 2% for FY20. So essentially, as far as our estimates are concerned, 120% of incremental earnings are coming from banking. The rest of all the sectors put together are dragging it down. So therefore, if you have to side with the earnings growth, banking seems to be the only story where there is a visibility, and within that private banks, within that corporate banks, and within that large corporate banks. So I would be extremely comfortable owning corporate banks. we are expecting for our private bank universe around 40% profit growth for this quarter.
What about PSBs in particular? You know, we've had the NCLT recoveries as well, but do you think they'll be able to aid profitability for PSU banks, or would they continue to reel under pressure in this quarter as well?
Public sector banks are concerned, our assessment is that SBI will do well because of the large recovery that we are seeing. Apart from that, the operational performance for the bank has also been good. Bank of Baroda will also see a major write back, so that will also aid the profitability. But other than that, the old challenges for the other banks could continue to persist. So that's a very difficult call to take at this point in time. SBI is still one of those banks which I think will is a safer bet to play, and it's our top pick for 2020.
Here's a word from Amnish Agarwal as well from Prabhudas Leeladhar. He expects earnings to be driven by banks, auto, agri and cement sectors, and also believes that the overall demand scenario, however, will continue to be muted.
Q3 is unlikely to give you any green shoots as far as the overall performance is concerned. Whatever growth in PBT is reflected, it is mainly led by financials because of the lower base and some of the write backs which are expected. So if you remove that, I think some of the sectors which could do well during the current quarter are, for example, financials are there, then cement is there, and I think barring these 2-3, most of the other sectors will remain muted. We are not expecting much surprise from IT in the near term, and we are actually underweight on IT because usually in run up to US elections, so the IT sector usually underperforms and the overall growth rate of the companies also suffers. If we are talking about, say, banks, while some of the private banks, they will continue to do well, there could be some still some skeletons in the cupboards which can come out, like DFHL is something which is known, but there could be some more incremental provisioning which might be required. Similarly, when it comes to your autos, I think we might have seen the worst. QOQ, there might be some improvement which is visible and the base effect is favorable. Now, as far as your other segments of consumption are concerned, I think it is going to be very, very mixed. Some of the companies, we might see some sequential improvement happening, say for example, companies like, say, your Kansai, but paint companies in general, or broadly, I would say that we are not yet out of the woods, and the growth rates definitely are going to be lower on YOY, and in some cases even on a QOQ basis the volume growth will be lower. So the capital goods sector will remain more or less a longish term story. The government is showing its intent to develop the infrastructure, but your expenditure might be slightly back-ended. The order inflow in the near term can suffer for sure, but in the longer term, the companies which are having, say, stronger balance sheet and good visibility, they will thrive.
Okay, just want to discuss the prospects of the auto sector. Pretty interesting considering if I just look at the last month's data, there are few odd green shoots and M&M tractor sales, for instance, which did manage to impress the street. Having said that, while the volume decay really continues for the overall sector, one has seen the stock prices post a completely different scenario. Most of the stocks have recovered 20 to 25% from their August lows. Gautam, what is your expectation of what auto as a sector is likely to report? And would you say that the worst of the volume decline perhaps is behind us?
Aisha, when you look at auto, you have to remember that last 6 quarters, the auto sector has shown double-digit profit decline continuously. So on that low base, we are expecting a very strong profit growth. But again, it is singularly led by Tata Motors. So if I look at my auto universe expectations, we are expecting a 26% profit growth. Moment I remove Tata Motors, that 26% growth becomes an 8% decline. So across the board, we are expecting profit decline. At the margin, what we are seeing is volume stabilization on a month-on-month basis. But I would still, reserve my view on that front, because we are going ahead and, we're going to see a transition on BS6. How does this transition pan out over the next 6 months will hold a very important bearing on where the auto numbers stabilize, both for two-wheelers, four-wheelers. As far as this quarter is concerned, clearly the low base is helping, and the swing from loss to profit for Tata Motors at the aggregate is making the numbers look better than what they actually are. So if you look at the big OEMs, except Maruti, we are expecting an earnings decline for all the other OEMs. Our preference for last 3 years has been in favor of four-wheeler compared to two-wheeler. So we are siding with Maruti, and after a long time, we have introduced a two-wheeler in our model portfolio. We have replaced M&M with a Eicher.
Okay, Eicher Motors and Maruti clearly the favorites when it comes to autos. Naveen, if I could combine the prospects of capital goods as well as infrastructure, we've all seen how muted the activity has been on ground. What are you hoping to hear in terms of an activity pickup from both these sectors?
See, as far as capital goods sector is concerned, typically you look at what Larsen has been reporting in terms of order inflows. So the order inflows on a YOY basis seems to have declined. So the total order book will still grow, but that growth is not going to be very, very significant, might be 2-3% odd kind of a growth. However, there is some bit of execution pickup which might have happened in the capital goods sector, and the tax rate cut, because of which overall the capital goods sector, our coverage universe will report decent set of numbers. So L&T will report 20% kind of a growth on earnings, probably 8-9% growth in revenues, but that's primarily led by execution. So execution is going to be one factor where I think capital goods sector might report decent set of numbers. However, on the infrastructure side, I think there are challenges. There has been slowdown, which has been quite significant. Order inflows have also slowed down quite significantly for the infrastructure sector. Apart from that, in certain states, there have been widespread problems in terms of the execution also, right? So infrastructure, I think, is going to be a challenge in this quarter. So they will report sluggish numbers. Most likely profitability is going to decline. Capital goods, I think so, still better. In capital goods, if I were to look at some of the companies like, let's say, Voltas or Blue Star, so those companies will still report decent set of numbers, right? So those are the companies that one can still play for. So overall, I would still be much more inclined towards the high quality capital goods. Infra is something which I will not be very, very gung-ho about at this point in time from a results perspective.
Sure. Point taken. We'll slip into a very short break on that note. Haven't taken one in a while. When we come back, of course, lots of sectors to discuss. But as we take a break, hear it out from Pramod Gubbi and what he expects in terms of performance from individual sectors in this quarterly numbers.
And it's difficult to pinpoint these bottoms in any case. So I would rather take a longer term view. At some stage over the next quarter or two, you will see the bottom. You will see some sort of recovery. If you have an horizon of 3 years or longer, I think autos is something that you should start looking at. You have to remember that it's impossible to time it perfectly. But to the extent that valuations are reasonably below intrinsic values, you can look at building positions there. Whether this is the quarter where it turns around or not, it's not going to make much of a difference in the longer term view. Even the companies which plan to capitalize on these tax cuts and start some capex activities will take time to go back to the drawing board and see how they can revisit in terms of new investment activities. So I would reckon it's too early to look forward to in this quarter's earnings commentary to see any sort of pickup in investment activity. We've already heard some of the management teams that we've met over the last few quarters. There's absolutely no signs of pickup in capex activity. But having said that, I think at some stage there are well-run companies which are already looking at increasing their reinvestment plans. Clearly, the government has given a sort of a gift in the form of those excess cash flows which are retained with them, which they can choose to deploy. Some of these companies in sectors which have secular growth are clearly looking to deploy them. Whether it's, again, this quarter or next quarter, it's anybody's guess, but at some stage you will see a pickup in investments.
Back with ET now, you're watching our special coverage on how earnings are going to pan out in this quarterly performance now that we're just on the doors of that. After a 2-year-long wait of just tepid performance quarter after quarter and consistently at that, Are we finally likely to see some green shoots, or it's going to be yet another tepid quarter? We've been chatting with our experts on precisely that. But first, before I take my discussion forward with our experts, let me take it across to Mubina Kapasi, my research analyst. She's waiting by with the ET Now polls on how oil, cement, infrastructure and metals as a sector are likely to perform. Mubina?
Well, I'll start off with metals. We've been talking, right here on ET now for the last couple of days about how there's that bit of recovery that's been witnessed, especially towards, the end of November and, the month gone by in demand and consequently in steel prices as well. And hence, if you look largely at what brokerages are saying, they're saying that it could be a bit of a better quarter on a sequential basis. However, don't expect any significant improvement in profitability on a year-on-year basis. Base metals have been more or less stable, but for the ferrous space, it's still lower on a year-on-year basis, while that moderation does continue on a QOQ basis. For cement, interestingly, this December quarter of FY20 may actually be one of the weakest quarters of the fiscal, because the December 2019 cement prices were at a 9-month low, and that weak realization will also translate into a lower EBITDA per ton as well. Volume expectations as well are pretty poor, so don't expect any dhamaka of sorts either on the top line or the bottom line of these cement companies. For oil and gas, meantime, the key parameter and the key feature of every oil and gas company is the GRM, and this time around as well it's expected to remain low. In fact, OMCs like HPCL and BPCL may likely see a dip in the GRMs, whereas for IOC it may just be flattish. IGL and MGL may report low double-digit growth in volumes. But when it comes to Reliance Industries, that may outperform on the GRM front because of the fact that the coker capacity has improved and also due to feedstock management. For the other upstream companies like ONGC and Oil India, once again, double-digit decline in profitability is what the ET Now poll is putting the number at.
Okay, Mubina, we'll let you go on that note. And Gautam, if I could come to you on the cyclical businesses, the likes of a cement, the likes of a steel, like Mubina was just highlighting, while Q3 earnings performance may be bad, but off late, one is finally seeing that bit of a revival come in. In Q3, you had north as well as eastern parts of the country report a price uptick, and now you're suddenly getting the channel checks indicate that southern states as well have undertaken a steep rise. And that can be, said about some of the steel names as well, because realizations clearly have been at the lower end. But would you say that if there is another weak quarterly performance, this is the time to buy into some of these names at the end and the tipping point of the cycle turning around?
Aisha, I will go more with the cement side of the cyclical businesses because the balance sheets are far more stronger there compared to metals. So cement, for example, this quarter also the volumes will be flattish. But the real game in commodity is always when prices change. If you recall FY19, we had seen cement volume growth of 14%, but there was no profit growth and stocks didn't do well. In FY20, you're seeing cement volumes turning flattish, but realizations are quite good and your input cost is fairly benign. So profit growth is extremely strong. Even in this quarter, for our universe, we are expecting more than 20% kind of profit growth. The problem is that at the margin, you're not getting that confidence that the infrastructure spend will really skyrocket. Here and there, you might see some project being announced. But from a capex cycle viewpoint, if you see the RBI's latest monetary policy document also, the capacity utilization has come off by 4 percentage points sequentially, from 73 to 69%. So a lot of this spaces one has to be extremely tactical to play. For example, metals, we have seen 3,000 odd rupees of price increase in the last 1.5 months, and that is going to reflect in fourth quarter. This quarter is obviously going to be very disastrous for metal from a earnings point of view because we are expecting almost 65% earnings decline. But the real thing to look at in metals is sequentially the EBITDA is improving. So yes, I mean, these are trading calls, these are trading plays. From our model portfolio point of view, where we are bullish is more towards financials, consumption and IT. And at the margin, we have increased weightage on some cyclicals like Ultratech, Ashok Leyland, those kind of names. We are still underweight on metals and oil and gas. And I'm happy to miss that rally because it's very tough to predict those quarterly, pricing changes.
Naveen, you track the consumer segment pretty carefully. Do you think the volume degrowth will continue to be the key highlight of this quarterly performance as well? Or in discretionary, at least, there could be a few odd aberrations, like a Titan, for instance, wherein their Q3 commentary indicates that it'll be a decent 11% jewelry growth?
Yeah, so if I were to look at the consumer segment, so let's talk about, let's say, Hindustan Unilever, right? So that's the bellwether of the sector. So we are expecting a 3% volume growth, which is slower than what they reported in the last quarter, which was 5%. So sequentially, Hindustan Unilever, we are expecting some bit of decline because there are also tactical reasons. The winter onset was little late, right? So those factors could have had some impact on the quarter. However, overall for the sector as such, if I were to combine the discretionary as well as the staple segment, there should be some improvement that we should see on a sequential basis. So the QOQ basis, there should be some bit of improvement coming in. Second factor is that there is some bit of increase that we are witnessing in the raw material prices, right? So palm oil prices are up quite significantly, crude is up, right? So that means the input costs are up. Not everything will get reflected in this quarter, but that will also mean that the companies will start taking price hikes, right? So going ahead, we should start seeing improvement in the nominal growth rate, right? Also, rural market should start faring better as we get into this part of the year, right? Because of the Rabi crop sowing season was pretty good, right? So I think overall from a growth perspective, the whole consumption sector should start doing better. Even the staple segment should start doing better, and the kind of outlook that Titan has given, this was the quarter where the base was very high for Titan, right? So the retail sales for Titan jewelry segment was 15%, right? That too on a base of more than 35%, right? So from that perspective, I believe that the worst seems to be over for the consumer sector as a whole. We are seeing some bit of improvement to come in. How much catch up it actually happens remains to be seen, because the price versus the value equation is a challenge for the consumer sector. Apart from that, we are seeing some bit of improvement coming in.
A seasonally soft quarter, Gautam, for IT. But again, can we expect maybe mid caps or large caps versus each other to perform a little better? Or would you say largely it will be a very muted, sedate kind of quarter?
Aisha, we've been positive on IT, and the recent global geopolitical events plus overall risk of environment has made us more positive on IT. The performance as far as this quarter is concerned is going to be similar to the trend that we've observed in the last couple of quarters. 1.3 to 2% kind of a constant currency organic growth, 7-8% profit growth. But IT offers you a very strong island of defense. It's not as expensive as consumer. And similarly, the earnings visibility is not as low as something like a pharma, which used to be a defensive at one point of time. So anybody who's looking to add defensive, IT provides a very ideal bunch of stocks. So we have added L&T Infotech in our model portfolio. We've replaced Tech Mahindra with HCL Tech, where we are more positive. And Infosys continues to be the anchor of IT in our model portfolio. So I remain quite positive on IT. Also, in 30 days, you will see a budget being presented. Depending on the fiscal maths of the government, I'm sure the currency will react, and overall global environment does make one believe that currency depreciation is around the corner. So all things are falling in place for IT at this moment, and valuations, while not cheap, are not exorbitantly expensive like some of the other defensive sectors. So this is where we are more positive, and we have increased our weights further in our model portfolio in this preview.
Okay, gentlemen, would have loved to chat a lot more. We can go on talking about earnings and digging out whether or not there are going to be any yellow weeds or green shoots, but have to end the show right here. But thank you so much, all of you, for taking the time out. Gautam, Naveen, Amnish, as well as Pramod, good having you in the show as always. Keep our fingers crossed. Hopefully, it's not going to be as muted, or if so, largely muted. We will have some green shoots emerge in this quarterly performance. Thanks so much for watching from all of us here.